The recent uplift in ESG investing and sustainability standard setting has swept up investors from all backgrounds. Judging by the headlines, it seems that everyone is turning toward ESG funds to boost their green credentials. However, the shift has been accompanied by a stark increase in concern over what has become called greenwashing. Many asset owners want to become more responsible investors, accounting for ESG and climate change as best they can, but the confusing world of greenwashing stands directly in the way of achieving their goal. This Minerva Briefing will answer the questions: what is greenwashing, how does it occur, and how can asset owners understand and address it? My name's Alex Whitebrook, ESG Communications Manager at Minerva Analytics, and this is a Minerva Briefing on greenwashing. Minerva, trustworthy data and insightful reporting for sustainable stewardship. So, let's jump right in. These are the topics we'll be covering today, starting off with a definition and history of greenwashing, before diving into a closer look at the many faces of greenwashing and finishing up with a rundown of the regulations and guidelines for European and UK-based asset owners to tackle greenwashing. Ultimately, this briefing will give you all the information you need to begin your sustainable stewardship journey. As mentioned, greenwashing is the practice of making false or misleading claims about the environmental benefits of a product or service. As the definition hints towards, the term has traditionally been associated with the retail world. For example, when a company known for its negative effect on the environment produces a product advertised as environmentally sustainable when it's not, or without changing any of the fundamental issues within their business. As the ESG investing space continues to grow, the demand for asset managers and financial services firms to go green is so strong that several are guilty of putting the cart before the horse, making unsubstantiated claims for environmentally and socially sustainable credentials before they've even made any meaningful change to their business practices. A second major cause of greenwashing is the fact that many asset managers see an opportunity to boost their brand image when they make green claims about a product or fund. This does not necessarily mean that the greenwashing is done with malicious intent. In fact, many fund managers may simply be trying to meet the needs of investors that each give a different meaning to the idea of sustainable investment. In the world of ESG investing, greenwashing can take many forms, and identifying it within your own portfolio is no simple task. Here, we have borrowed from the retail world, which knows greenwashing all too well, to explain how it can affect your investments in a clear and simple way. The 7 sins of greenwashing were developed by environmental marketing firm TerraChoice in 2009 to explain the many ways greenwashing can be hidden within a product or service. I'll quickly go through each of them now to give you a strong foundation for approaching investment options with greenwashing in mind. First, there's hidden trade-offs, environmental claims that emphasize certain benefits at the possible expense of other environmental factors. For example, the electric car manufacturer Tesla is a popular investment for many ESG portfolios. However, lithium mining for the manufacture of electric car batteries is known to cause environmental and social issues, so this can be a hidden trade-off within that investment. The second one is lack of proof, environmental claims that are not backed up by factual evidence or third-party certification. ESG funds without third-party certification or evidence of their ESG credentials is a common issue for UK investors. However, developments are underway, with the Financial Conduct Authority publishing a letter this year addressed to authorized fund managers on improving quality and clarity of their disclosures. The third sin is vagueness, environmental claims that lack specificity and may be deemed as meaningless. For example, if a company claims it's sustainably run, it's not necessarily sustainable. For example, the 2021 voting season saw a relatively successful campaign against fossil fuel companies that are making net zero commitments but not evidencing them within their annual reports. And the fourth sin is false labeling, false environmental certifications invented to mislead customers. Now, these are not very common in the world of investing, but it is certainly true that not all ESG labels are equal. Some funds may invest in controversial products with sustainable labels that are not reliably verified. On to the last 3, and the first is irrelevance. Claims of environmental benefits that are unrelated to the environmental impact of a product. For example, if an ESG fund composed of companies in the energy sector claimed for some reason to be certified as sustainably organic. Synthetic funds are another example where this irrelevance issue can occur, when their investments are based on climate-aware large-cap funds, but they don't have any specific commitment to investing in climate-aware companies. The second last sin is the lesser of 2 evils. This is when environmental claims are made about a product or service that has no environmental benefit to begin with. For example, many ESG funds may include fossil fuel companies despite their emissions. This may be due to the company's environmental commitments or because the fund manager engages the company to push it towards greener practices. Again, this is another example of how greenwashing may not always be done with malicious intent. And the last sin is fibbing, environmental claims that are false. This has occurred in past examples such as the Volkswagen emissions scandal. We actually have a full article covering this issue if you would like to read more about our take on the Volkswagen scandal, and we've provided a link for you to that article below. Addressing the many different forms of greenwashing requires diligence and purpose in your investment decisions. It's not only important to consider what you're invested in, but how you act as a steward of your investments. Stewardship is defined by the Financial Reporting Council as the responsible allocation, management, and oversight of capital to create long-term value for clients and beneficiaries, leading to sustainable benefits for the economy, the environment, and society. As experts in sustainable stewardship, Minerva is well poised to help asset owners address greenwashing and help eradicate it from the investing world. Now we've uncovered the many different faces of greenwashing, this briefing will provide you with a list of resources or regulations you can look to for guidance in overcoming greenwashing and greening your investments. The Task Force for Climate-Related Financial Disclosures and its recommendations are an excellent tool for addressing greenwashing. Established by the Financial Stability Board to develop recommendations for more effective climate-related disclosures that could promote more informed investment decisions, the TCFD primarily works with companies to implement the recommendations and promote advancements in the availability and quality of climate-related disclosure data. Its recommendations act as a globally agreed-upon set of standards for companies and investors alike to adhere to. They also help prevent greenwashing by recommending that asset managers scrutinize the quality of climate-related data reported by companies, looking at the 4 levels or thematic areas of climate reporting mentioned here. Minerva offers a TCFD consultation service to help investors identify climate change risks and opportunities and meet regulatory requirements. Together with our strategic partner Selective, we're ready to help investors implement benchmarks suitable to their investment strategy, starting at these 4 areas outlined within the TCFD. Bringing it down now from a global focus to a regional one, more specifically for asset owners based in or working within Europe, the Sustainable Finance Disclosure Regulation and EU Taxonomy are extremely important new regulations for tackling greenwashing. Both are key components of the EU Green Deal. By providing appropriate definitions to companies, investors, and policymakers on which economic activities can be considered environmentally sustainable, it's expected that the EU taxonomy will create security for investors, protect private investors from greenwashing, help companies to plan the transition towards net zero, and mitigate market fragmentation, eventually helping shift investments to where they're most needed. Alongside the EU taxonomy, the SFDR provides a series of sustainability-related disclosures which must be made in the documentation of a financial product and on an asset manager's website. These disclosures affect any UK-based asset managers or owners who distribute financial products in the EU. More importantly, for investors and providers of financial services within the UK, the recently announced Sustainability Disclosure Regulation regime will integrate elements of the SFDR, EU Taxonomy and TCFD as a broad framework for disclosures. The impact that all these regulations will have on improving the state of ESG investing will be substantial, so be sure to keep up and tackle greenwashing alongside them. If you're a UK-based asset owner, the first place to begin your journey toward understanding ESG investing and avoiding greenwashing is the Stewardship Code. The latest version of the Stewardship Code from 2020 requires signatory asset owners, asset managers, and service providers to explain how they have exercised stewardship in relation to a far broader range of asset classes and calls for better integration of ESG and climate change considerations into stewardship processes. It specifically addresses greenwashing in its apply and explain principles, meaning signatories must apply the principles within the code or otherwise provide a legitimate explanation as to why they cannot. This keeps issues from being swept under the carpet as they have been in the past. Adding to the momentum of the new Stewardship Code, the UK's Financial Conduct Authority has published a business plan for 2021 and 2022, announcing the rollout of economy-wide rules aligned with the TCFD recommendations. This is just the tip of the regulatory iceberg, with many new rules on their way soon in the UK and global markets as the ESG investing space matures. In addition to these global, regional, and country-level regulatory frameworks, sustainability governance ratings are one of the most effective ways any asset owner can account for environmental sustainability in their investment decisions. They help you look beyond the environmental claims made by an ESG fund or report to see whether the day-to-day governance of a company is linked back to environmental sustainability through commitments like alignment to the Paris Agreement. Minerva's Sustainability Governance Rating Tool enables investors to address climate strategy governance. It is aligned with key international frameworks including the TCFD, the Transition Pathway Initiative, the UN Sustainable Development Goals, and the EU taxonomy. Tackling greenwashing is by no means a simple task. That said, standardized regulation is coming to the ESG investing space, making it easier to identify the many symptoms of greenwashing and remove it where appropriate. The tools, guidelines, and regulations identified within this briefing are just a starting point for asset owners looking to step up their stewardship and become responsible investors. If you would like to find out more about how you can tackle greenwashing, we provide a range of services from sustainability ratings just mentioned to TCFD compliance advice, and with over 20 years of experience in ESG investing, Minerva, together with our partners at Solactive, are ready to help you integrate climate and sustainability into your investment strategy. Find out more by downloading the full briefing today or say hello at minerva.info. Thank you again for joining us in this Minerva briefing, and please check out the full range of briefings directly on our Bright Talk channel. There's a new briefing every month, so stay tuned and see you in the next one.